Welcome back to the ComLucro channel. In this video, we are building a complete smart money masterclass focused on how price actually moves. We will break down market structure step by step, explain how valid breaks and changes of character work, and show how trends are maintained or invalidated. Once that foundation is clear, we will move into liquidity and inducement, explaining why so many valid-looking setups fail and how smart money creates traps inside structure. From there, we will apply the ICT optimal trading zone as our execution model, showing how professional traders wait for liquidity to be collected before entering with precision. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, let's get started with the market structure. The behavior of market movements can fundamentally be attributed to two main factors that consistently dictate the direction of prices: trends, which encompass both uptrends and downtrends, and the consolidation phase, characterized by choppy or ranging markets. Picture this as a perpetual cycle, where prices continuously oscillate between downtrends, uptrends, and consolidation periods, each gathering liquidity and institutional orders. Typically, prices need to consolidate following uptrends and downtrends. A vital initial step when analyzing your charts is determining whether the market is currently experiencing an uptrend, a downtrend, or is in a consolidation phase. To build a robust understanding, let's start with a straightforward overview of market structures before exploring the intricate details of advanced market dynamics. Consider an idealized version of a market structure reflecting a perfect uptrend. I term this as ideal because it's rare to encounter an uptrend in real markets that follows this pattern precisely. Markets don't usually move with such predictability. Nevertheless, to enhance our understanding of uptrends, let's examine this ideal model before shifting our focus to the more realistic uptrend structures that are more commonly observed. In a typical uptrend, prices will consistently create higher highs and higher lows. The pattern generally sees prices surpassing previous highs while sustaining the lows. An uptrend concludes when there is a break below one of the significant lows. To preserve the continuity of an uptrend, it's essential that these major lows remain unbroken. Additionally, when a price exceeds a major high, it results in a structural break and forms a demand zone, indicative of a break of structure, or BOS. Accurately identifying major highs and lows is crucial because it allows us to recognize signals for potential trend reversals or continuations. Without correctly pinpointing these key points, traders are at risk of misinterpreting market signals and potentially entering trades on the wrong side of the market. These principles are equally applicable in bearish scenarios. During downtrends, prices consistently form a sequence of lower lows and lower highs. In such scenarios, prices tend to break below previous lows while still respecting the previous highs. Let's explore the details of a realistic market structure, focusing on the more commonly observed uptrend patterns in the market. Consider a scenario where the price surpasses previous highs, breaking upward. At this juncture, a key question emerges. How do we pinpoint valid major highs and lows? To address this, let's examine the left side of the market structure. It is evident that the price underwent an upward trajectory until it began to retrace. The peak reached before this retracement is deemed the major high. Conversely, the lowest point during the bullish wave that triggered this upward movement and led to a break of structure and a new high is recognized as the major low. These 2 points are the critical external structures of the market, and any structure that develops between them is considered an internal structure. When the price surpasses the major high, marking a break of structure, BOS, it indicates a continuation of the upward trend. On the other hand, if the price drops below the major low, this should be interpreted as a signal of a trend reversal. The internal price actions within these external structures are secondary, provided the price stays above the most recent major low. Maintaining this condition signals that the market remains in a bullish phase. You might wonder why this low at the extreme is treated as the major low. The reason is that it represents the ultimate low point before the price starts its upward trajectory. This particular point is essential as it's the pivotal low that catalyzed the upward movement and the subsequent break of structure. Now, let's transition to the bearish scenario, which mirrors the bullish scenario. The bearish wave begins, leading to a structural break. We also identify a major low, marking the lowest point reached after the structural break. These 2 points, a major high and low, act as our external structures, while all structures developed between them are viewed as internal. Should the price break these major lows downward, it signals a continuation of the trend as illustrated here. Conversely, if the price climbs above the major high, this would be indicative of a potential trend reversal. In simpler terms, the internal price actions within these external boundaries are secondary, as long as the price remains below the most recent major high, signaling a bearish market. As the price retraces upward, it establishes a series of internal highs and lows within our defined trading range, yet it eventually ascends, breaking the recent major low downward. This internal high, situated at the extreme, is now recognized as the new major high because it marks the highest point reached before the price initiated a strong bearish push, resulting in another structural break. Following this, the price undergoes another retracement, forming another major low. After establishing various internal structures, the price sustains its downward momentum, creating a sequence of lower lows and lower highs. Now, let's explore another vital concept in market structure analysis, the break of structure, BOS. You might have come across this term in various trading tutorials, market structure videos, and handbooks. Typically, in a bullish scenario, a BOS is often simply described as a situation where the price surpasses a previous high. However, to accurately utilize this concept, specific criteria and rules need to be adhered to in order to confirm a valid break of structure. Let's dive into these key points and rules. A valid break of structure is confirmed when the price not only breaks, but also closes above the most recent higher high with the candle's body. This validation holds even if the price retraces downwards immediately after the break. In such instances, the market establishes a new major high and major low, defining a new trading range. Should the price then break this newly established major low heading downwards, it suggests a potential trend reversal, indicating a shift from a bullish to a bearish stance, a change of character, or CHOCH. Continuing our exploration, if the price breaks the previous higher high with a long wick or shadow, and the body of the candle closes below the high's range, and if the subsequent candle's wick does not exceed the first candle's wick, this does not qualify as a valid break of structure. In this instance, the resulting low is treated as an internal structure within the trading range. For a reliable indication of a trend reversal or a valid change of character, we need to observe the price breaking below the significant low at the extreme, rather than merely breaking above an internal high. Now let's consider a different scenario. If the price surpasses the recent higher high with a wick, and the body of the first candle closes below the high's range, but the subsequent candle's wick exceeds the first candle's wick, we then recognize this as a valid bullish break of structure. Here, a new major high and a new major low are established, outlining our updated trading range. The internal price action within this defined range is less significant, provided the price remains above our newly established major low, which signifies a bullish market. If the price later breaks this newly formed low downward, it then acts as a clear indicator of a trend reversal or a valid change of character. Transitioning to the bearish scenario, which mirrors the bullish one. For a bearish market structure to confirm a valid break of structure, the price must break and close below the most recent lower low with the candle's body. If the price breaks the newly created major high upwards, this signals a trend reversal, suggesting that control has shifted from sellers to buyers. Conversely, if the price breaks the recent lower low with a long shadow or wick and the candle's body closes above its range without the subsequent candle's shadow exceeding the first candle's wick, this is not considered a valid break of structure. To confirm a genuine break of structure, the price must close below the low's range with the candle's body. Moreover, if the subsequent candle's wick surpasses the first candle's wick and closes above the low's range, this then qualifies as a valid break of structure. We must also update our major low and major high accordingly. As long as the price stays below our newly established major high, the market is considered bearish. Only if the price breaks this new high upward do we acknowledge it as a valid signal for a trend reversal or a major change in character. Having explored various types and scenarios of break of structure patterns, and now possessing a solid understanding of what constitutes a valid BOS, let's delve into another key aspect of market structure mapping, the change of character, or CHOCH. The first step in identifying a valid change of character involves determining the general market direction, whether it's an uptrend or downtrend. Next, you need to highlight the valid breaks of structure on your price chart. In the bullish scenario, consider how the price forms a series of valid breaks of structure. The low and high that define these breaks are our major structures associated with the first valid bullish BOS. As previously noted, any price action that occurs between these two structures is deemed internal. Change of character patterns can be categorized into two types, minor and major. For instance, each time the price breaks any internal low, it signals a minor change of character. It's crucial to understand that a minor change of character alone should not be taken as an indication of a complete market structure shift. Here, we encounter a common pitfall in the market. Many novice traders who have not properly identified the market structure often misinterpret a minor change of character as a signal for a reversal in market direction. Believing that the bullish phase has ended, they might think it's an ideal time to enter a short position. Typically, they place their stop loss just above the internal high. However, contrary to their expectations, after a brief retracement, the price climbs again and continues its upward trajectory. This often results in hitting the stop loss of traders who took short positions. They frequently fail to understand why their stop loss was triggered by the price and tend to repeat this mistake. What they miss is a crucial detail. The price did not break the major low that would confirm a shift in market structure. They should not enter a short position until the price breaks the last major low to the downside. Their perceived change of character was invalid, and the price was merely in its retracement phase before resuming its primary upward direction. To capture a valid market structure shift signal, traders should patiently wait for the price to establish a major change of character by breaking and closing below the last major low that initiated the upward movement leading to the bullish break of structure. Furthermore, it's essential to remember that in a bullish scenario, a change of character pattern is only considered valid if the price breaks and closes below the last major low using the body of the candle. If the price breaks the most recent high with a long wick or shadow and then closes within the high's range, the change of character is deemed invalid and cannot be seen as a decisive market structure shift. This principle is mirrored in bearish scenarios. For a change of character to be considered valid and highly probable, the price must break and close above the recent major high with the candle's body. Any penetration merely by a shadow or wick is regarded as insufficient. Understanding valid breaks and changes of character gives us the structural framework of the market. But structure alone does not explain why so many valid-looking setups still fail. This is where liquidity comes into play. Most false breaks, failed reversals, and invalid changes of character are not random mistakes by the market. They are deliberate moves designed to create liquidity, trap traders, and fuel the next institutional move. To fully understand market structure, we must also understand how liquidity is engineered inside it. Now that structure is clear, let us talk about inducement and why it plays such a critical role in liquidity. Traders, do you know what inducement really is? Inducements are specific market setups designed to tempt traders into entering positions, often in the wrong direction, so smart money can collect liquidity. In simple words, an inducement is a trap for traders that makes them enter the wrong direction before the real move starts. Because smart money needs liquidity, They induce traders into early breakouts, fake reversals, or fake pullbacks. Order blocks that look clean but are not the real ones. FVG fills that look like entries, equal highs or lows that look tradable, and etc. Then price reverses, sweeps their stops, and moves in the intended direction. If you ask why understanding inducement concepts is important, it is because this understanding helps you avoid entering too early at fake levels or liquidity traps, and instead wait for the real point of interest. This dramatically improves the win rate. Let's continue. At its core, inducement means creating liquidity before the real move. It is the last liquidity created to fuel the real move, and it shows up in different forms: structural inducement, liquidity-based inducement, and time-based inducement. Now, let's start with the structural inducement. Among all types, structural inducement is the most important because it happens directly inside market structure and forms patterns you see every single day. A structural inducement occurs when price creates a fake structure shift, like a false CHOCH or a misleading BOS that tricks traders into entering early or in the wrong direction. In this example, price is trending higher and continues to print bullish breaks of structure to the upside. However, when you focus on the most recent break of structure, it initially appears completely valid. Price breaks and closes above the swing high. Naturally, this leaves you to expect buy setups at the demand zone or order block that caused that break. Then the outcome becomes clear. You enter the buy and price takes you out almost immediately. This is exactly how structural inducement traps the majority of traders. The reason behind this becomes clear when you look deeper. This so-called BOS was never a real break in the first place. The entire move was driven by resting buy orders sitting below, inside the discount zone of the main bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you will notice that price did not even retrace into the 38.2% level, let alone the 50% level of the previous impulse. This is critical. For us at ComLucro, a retracement that does not reach at least the 38.2% level cannot be considered a valid retracement. And even when price retraces only to the 38.2% level, these very shallow pullbacks tend to create inducements and liquidity hunts rather than clean entries. Because of that, traders must always be cautious with shallow retracements. The ideal scenario in a bullish trend is to wait for price to retrace into the 50% level or deeper, where price enters the discount zone. This is where real institutional buying is more likely to occur, and where you avoid becoming liquidity for inducement moves. Understanding this helps you avoid fake structure breaks, recognize liquidity-driven pullbacks, and stay aligned with the real direction of the market. Now let's look at another chart example. Here you can see that price is in a clear downtrend, but if you look closely, you will notice something important. Price broke and closed above the major swing high of the last bearish impulse leg. At first, this looks like a bullish change of character, a signal that the bearish trend might be ending and the market is about to shift direction. So naturally, you might start looking for long opportunities inside the fair value gaps within this bullish leg. Or you might wait for the price to reach the bullish order block at the extreme. But every time you enter a buy setup here, you get stopped out and liquidated. The truth is, this is a fake change of character, a structural inducement designed to trap buyers. Here is why. If you draw a Fibonacci tool from the swing high to the swing low, you will notice that price does reach the 38.2% retracement. However, this retracement is extremely shallow, and shallow retracements like this have a high probability of creating inducements and liquidity hunts rather than real reversals. Because price never reaches the 50% level or deeper, it never truly enters the premium zone of the previous impulse. This tells us that the entire bullish move is nothing more than a pullback designed to activate unfilled sell orders left behind during the bearish leg, while trapping early buyers along the way. And that is exactly what happens here. Price takes out the early buyers sitting above the swing high, which itself acts as an inducement level. It reacts from an internal liquidity pool, a fair value gap inside the leg, and then continues aggressively downward. In scenarios like this, you should not be looking for buys. You should be looking for sell opportunities. Otherwise, you'll get trapped again and again by the same pattern that most traders fall for. This is one of the most common inducement scenarios in the market, and thousands of traders step into this trap every single day. Now let's move on to the second type of inducement. Liquidity-based inducement is the most common form of inducement you will see in the market. This is when price intentionally creates a new high, a new low, or a small order block or breaker that looks too clean, with the sole purpose of trapping traders, collecting their liquidity, and then delivering the real move. And this happens every single day, on every market, and on every time frame. The main objective behind this behavior is to generate stop losses that smart money can use as fuel. By pulling retail traders into the wrong side of the market, their stops can be collected right before the true move begins. That is why you constantly see a tiny high before price drops, a tiny low before price rallies, a fake breakout before a reversal, or equal highs and lows getting swept by 1 or 2 pips. These are not coincidences. This is smart money deliberately engineering liquidity. With that in mind, let's go deeper and look at real price chart scenarios. Here we have a trading setup where price taps into a very strong daily demand zone and reverses, forming a valid change of character. Naturally, we expect price to pull back into the bullish fair value gap, sitting in the discount area, which is where we want to look for buys. However, before price fully taps into the 1-hour fair value gap, something important happens. Price pushes lower, reacts briefly near the fair value gap, and then immediately reverses, forming a new lower low. This new micro low is pure inducement, and this is exactly where many traders get trapped. That minor low convinces premature buyers that price has already mitigated the 1-hour fair value gap, and that the reversal is already underway. Because of fear of missing the move, they enter too early and place their stop loss right below that micro low, creating a clean pool of sell-side liquidity. This is precisely what smart money is looking for. Smart money uses this inducement to trigger early buyers, build liquidity below price, make the market appear weak, and trap retail traders who place sell stops under the micro low. All of those stops become the liquidity institutions need to fuel the real bullish move. Once enough liquidity is available, price dips slightly lower, sweeps the inducement low, collects those stops, and finally mitigates the true fair value gap, the one institutions were targeting from the very beginning. At this stage, liquidity has been collected. The imbalance is filled, and the true institutional point of interest inside the fair value gap has now been mitigated. However, inducement does not always appear as clean or as simple as the previous scenario. In some cases, instead of forming a small micro low, price creates a fake change of character on its way down and builds equal lows just above a tiny, very clean order block. At this point, 3 components are working together. A fake bullish CHOCH, equal lows which build a strong liquidity pool filled with retail stop losses, and a fresh, very small order block that formed inside the CHOCH leg. This tiny order block is not a real point of interest. It exists purely as an inducement. Its only purpose is to lure traders in early and attract even more premature sellers before price reaches the major true point of interest below. Smart money uses this small order block to generate additional stop losses beneath it, increase available liquidity to fuel the real move, and encourage retail traders to enter early based on a false signal. Now, you might wonder why price needs to form an inducement right before tapping into the fair value gap. The reason is simple. If price moves directly into an FVG with no inducement, there is no liquidity. Smart money has no fuel to reverse the market. The reaction out of the FVG becomes weak, and the entire setup can fail due to a lack of sellers to buy from. In simple terms, inducement is what creates the liquidity that fuels the move out of the fair value gap. Now let's move on to another trading scenario. This is one of the most common inducement sequences in smart money concepts, a pattern you will see every single day on the price chart. Let's imagine the price is in an uptrend and moving toward a key supply area. As price gets close to this zone, it begins to act strangely. First, price breaks a small swing high. This fake BOS immediately traps breakout buyers, traders who think the trend is continuing. Anyone using tight stop losses? Right after this fake breakout, the market forms equal highs or almost equal highs. This traps retail traders who think this looks like resistance. Let me short before I miss the move. These early sellers leave their stop losses right above the equal highs, creating a clean liquidity pool. Before the price reaches the real supply zone, the market often creates a small clean order block by pushing and closing below the most recent higher low. With this single move, price has already swept the stop losses of the breakout buyers, the stops of buyers who entered from the fake bullish breakout order block. Then price immediately reverses direction and pushes upward. On this move back up, the market triggers the stop losses of early sellers who shorted from the tiny inducement order block, the stop losses above the equal highs. At this point, buyers and sellers are both trapped. Price action traders and even some SMC traders have been manipulated near a key higher time frame supply zone. Only after building these inducement levels does price finally move into the real institutional supply zone, the zone containing actual institutional orders, not retail traps. This is where smart money enters their true sell positions, and from here, the real bearish delivery begins. The move smart money intended from the very beginning. If price creates a clean micro setup right before a major POI, it is an inducement. So always wait for an inducement to form, then enter on the real POI behind it for having A+ entries. Now let's move on to the third type of inducement, time-based inducement. Time-based inducement refers to situations where the market creates a trap move during high-volume time windows, typically right before or right after a major session open. This type of inducement is one of the most powerful because it happens every single day, and it offers one of the best opportunities to build a clear trading plan and stay aligned with institutional money. At this point, you might wonder why this type of inducement occurs so consistently. The reason is that during major session openings, multiple factors come together at the same time. Fresh liquidity enters the market. New order flow is introduced instantly. Retail traders become highly active, and smart money takes advantage of this moment to manipulate price, create a fake move, trap traders, collect liquidity, and then deliver the real move they intended from the very beginning. Let's look at an example here on the euro-dollar chart. Price was moving sideways during the London session. As the New York session approaches its open, watch closely what happens next. Right at the session open, price makes a fake push to the upside, sweeping the liquidity that was built above the London session high. Retail traders jump in with aggressive buy positions because price breaks above a double top. To them, this looks like a clear bullish breakout. But immediately after clearing the buy-side liquidity, price reverses sharply in the opposite direction and takes out the London low as well. With this move, both early buyers and early sellers get stopped out. After price breaks below the London low, many traders think this is finally the real direction. The short now looks confirmed. But once again, the market aggressively reverses in the opposite direction, collects liquidity, and then delivers the true move that smart money planned from the very beginning. This entire sequence is what we call time-based inducement. Time-based inducement shows us when and where the market is most likely to trap traders. But recognizing the trap is only half of the equation. The next step is knowing where to position yourself after liquidity has been collected. In this masterclass, we choose to use the ICT Optimal Trading Zone because it is one of the most effective execution models we use here at the ComLucro channel to align entries with real institutional intent. So, what is ICT's Optimal Trading Zone and Optimal Trade Entry? This is a structured trade entry framework built around price swings, Fibonacci retracements, and market structure. Its goal is to identify where a pullback is most likely to end, allowing traders to enter with precision instead of chasing price or reacting late. After a valid impulsive move breaks market structure, we apply the retracement tool to define the correction range, the optimal trading zone, located between the 61.8% and 78.6% levels. Highlights areas where institutional participation is likely to return in the direction of the dominant trend. By combining market direction, price swings, and optimal entry placement with concepts such as fair value gaps and multi-time frame confirmation, this model creates a clear, repeatable framework for high-probability trade entries. Now let us get started. As we begin our chart analysis, the first step is identifying the main price swings and key structure levels. In other words, using a top-down approach from higher time frames to lower ones allows us to build a complete understanding of market conditions across all levels. When we refer to higher time frame key levels, we're looking at the weekly, daily, and 4-hour charts. Any time frame below 4 hours is considered too short-term for large institutions to properly execute and refine their strategies. When we observe price reacting from a higher time frame resistance level, it is reasonable to assume that institutional participants showed interest in selling at that area. On the other hand, if price moves higher from a support level, it indicates that institutions were likely interested in buying at that point. This approach keeps our focus away from minor intraday price noise. Instead, we concentrate on meaningful moves that suggest strong participation from major market players. These broader trends appear clearly on higher time frames, which we have consistently highlighted as essential for proper analysis. As a result, identifying higher time frame swings and key levels allows us to see the market from a wider perspective and avoid positioning ourselves against dominant flows. From there, we can shift our attention to lower time frames, such as the 1-hour and 30-minute charts, to identify potential trading opportunities. When observing the chart, you will notice that the market consistently moves through impulsive and corrective waves. This fractal behavior exists because of how market participants interact with price. Impulsive waves tend to drive price a greater distance with strong momentum, usually shown by same-colored candles with large bodies. In contrast, corrective phases reflect indecision, appearing as mixed-color candles with smaller bodies and sideways wicks. Being able to identify the end of a pullback and the beginning of the next impulsive move can be extremely profitable, as it allows traders to position themselves early in potential buying or selling opportunities. Now imagine we're in an uptrend and want to buy low and sell high to take advantage of this bullish market. We cannot enter a buy position immediately because price is already extended and may correct at any moment. That is why we wait for a pullback to enter at a more favorable price. The most recent impulsive move started from this point and pushed price higher all the way to this level. The correction will take place within this range, and once enough liquidity is collected and buyers step back in, price is likely to continue pushing higher. If price breaks below this level, it suggests that buyers are no longer in control and the entire uptrend narrative comes into question. This signals strong bearish momentum and a potential reversal, unless the move turns out to be a fake-out designed to collect liquidity below the low before price resumes higher. Now let us return to the correction range. This brings us to an important question. Where should we place our long position and enter the market? If we enter too early, price may continue pulling back deeper, and we could be stopped out even if our overall analysis remains correct. On the other hand, if we wait too long, price may already start moving higher, and we miss the opportunity entirely. So the key to trading in the direction of the dominant trend is identifying the end of the correction, which signals the beginning of the next impulsive move. But how do we identify that moment? This is where Fibonacci retracement levels become essential. We always draw this tool from the start of the impulsive move to its end because it helps define the correction range. Once applied, you will notice several levels appear on the chart. Each of these levels can act as support and potentially cause price to react or reject when reached. However, two specific retracement levels form what ICT defines as the optimal trading zone, or OTZ. These are the 61.8% and the 78.6% levels. There are several reasons why this zone is considered an ideal area for trade entries. Reason number one is a better risk-to-reward ratio. Regardless of where we enter, the first logical target for the trade is the most recent market structure level. When price reaches this level, some traders will take profits or close positions, while others may enter new trades. This behavior can cause a pause, a pullback, or even a reversal. That is why this level serves as our first target. When entering inside the OTZ, the risk to reward becomes more favorable. We always aim for trades with at least a 1 to 2 risk to reward ratio. This is why trading within the optimal trading zone provides a higher risk to reward and results in a more structured and rational trade. Reason number two is a safer entry. The market often looks to remove early buyers and use their positions as liquidity for future moves. That is why waiting for price to reach the optimal trading zone and then searching for long signals can significantly improve our win rate. Of course, every strategy has its drawbacks. With a more conservative approach, we may miss some trades, but missing a trade is always better than taking a loss. Reason number three is a safer stop. The most logical and secure area to place our stop loss is below the most recent swing low. If price breaks below this level, it signals a market structure shift. In that scenario, buyers lose control, and the bullish case becomes invalid. Because of this, bulls will strongly defend this level. As a result, the closer our stop is placed to this swing low, the safer the trade becomes. This is the third reason why entries inside the OTZ are preferred. With all of this in mind, identifying a valid entry trigger within this zone is an effective way to execute a high probability trade. This trigger can come from different price action signals, which we will explain later in the video. Now that we have clearly defined the optimal trading zone, let us move on to ICT's optimal trade entry model. This trading model is built around three simple steps: analysis, execution, and trade management. Let us begin with the analysis phase. As mentioned earlier, this strategy is a trend continuation setup, where our goal is to anticipate the end of the pullback or correction and align ourselves with the dominant trend by entering long. In the first step, our goal is to define the market direction and identify the most recent impulsive wave. We only apply this setup when the direction is clearly established. To be considered valid, the latest impulsive move must break the previous market structure. At this point, there is one final condition to check. We must confirm that there is sufficient room for price to move before reaching a higher time frame key level. If price has already mitigated a major supply zone on the higher time frame, we will not enter a buy trade without additional confirmation, because that level has enough influence to potentially reverse the prevailing uptrend. So during the analysis phase, we focus on three things: market direction, the latest impulsive wave, and the available room before price interacts with a higher time frame key level. The next step is trade execution. Here we wait for price to pull back and then apply the Fibonacci retracement tool from the beginning of the impulsive move to its end. We place a buy limit exactly at the midpoint between the 61.8% and 78.6% levels, which is the 70.5% retracement. Our stop loss is placed a few pips below the swing low. The final step is trade management and target selection. We know that when price reaches this higher time frame area, it is likely to act as resistance and push price lower. Because of that, our first target is set just before this level, often near the close of the highest candle. The same logic applies when trading a bearish scenario. So as you can see, this model relies entirely on basic price swings and retracement levels. At this point, some of you may think that trading cannot be this simple and still remain profitable. However, simplicity plays a crucial role in forex trading. Your trading plan must be clear and straightforward, with mechanical rules that precisely define where your entry, stop loss, and targets are placed. By trading this way, you can rely on your backtesting results with confidence, knowing that emotions are removed from your decision-making process and that your tested results closely reflect real market conditions. Now, this was the core version of the model. We have expanded it further by combining it with multiple smart money concepts, including fair value gaps, market structure shifts, and multi-time frame entries, which we will explain next. We begin with the first type of entry by combining the optimal trade entry model with fair value gaps. Here we have a well-defined uptrend. Our objective is to wait for a pullback and enter a long position at a more favorable price. If price breaks below this level, the entire bullish scenario comes into question, as it signals strong bearish momentum. This defines our correction range, and by applying the retracement tool, we can clearly identify the optimal trading zone. Now, if we look to the left side of the chart, we can see that the most recent impulsive move has formed several fair value gap areas, one of which aligns directly with the optimal trading zone. When price retraces into these zones, they can act as support and potentially drive price higher. A more conservative approach, however, is to wait for price to retrace deeper into the third fair value gap and enter the long position there. This is because price may use the first fair value gap as a liquidity grab, trapping early long positions. In summary, combining the optimal trading zone with fair value gap areas creates strong supply and demand zones and offers a high-quality trading opportunity. So, we move on to the second type of entry by combining the optimal trade entry model with market structure shifts. Here, we had a long-term downtrend until price failed to form a new lower low, signaling a loss of bearish momentum. Shortly after, price broke through the supply level to the upside. This change of character indicates that sellers are no longer in control and suggests a potential bullish reversal. Once price breaks structure above the previous high, it confirms that buyers have taken full control, marking a complete market structure shift from a downtrend into an uptrend. At this point, we can begin looking for long opportunities to benefit from the emerging bull market. This leads to an important question. When should we enter a long position? Even though price has a strong probability of continuing higher, entering at a poor level could still result in a stop out. This is where price swings and ICT's optimal trade entry come into play. Our directional bias is bullish, and there is sufficient room for price to move before reaching the next significant higher time frame level, located above. We can now apply the retracement tool to the most recent impulsive move and place a buy limit at the 70.5% retracement level. Our stop loss is set a few pips below the swing low, and our targets are defined according to the trading plan. This is how we combine optimal trade entry with market structure shift concepts to execute a high-quality trade. Now we move on to the third type of entry, using a 2-time frame entry approach. In this trading setup, we use 2 different time frames to execute the trade. Most of our analysis is done on a higher time frame, such as the 1-hour chart. And then we zoom into a lower time frame, like the 15-minute or 5-minute chart, to find confirmation and execute the entry. Let me walk you through the process. On the 30-minute chart, we can clearly identify an uptrend. We apply the retracement tool and define the optimal trading zone. As discussed earlier, once price pulls back into the optimal trading zone, we shift our focus to a lower time frame to look for an entry trigger and execute the long position. However, on the lower time frame, this same pullback may appear as a short-term downtrend. Our objective then is to identify signals that show this lower time frame downtrend is coming to an end, allowing us to enter a long trade in alignment with the dominant bullish direction of the higher time frame. When we observe a clear change of character, it provides a valid signal to consider a long entry. In this example, we know the higher time frame trend remains bullish and price is trading within the optimal demand area. As a result, we have combined multiple price action concepts and confirmations to justify this trade. Combining optimal trade entry with additional price action techniques such as fair value gaps, liquidity concepts, chart patterns, candlestick structures, or any other entry confirmations you use can create a robust and well-structured trading strategy. Before we wrap this up, it is important to understand that ICT's optimal trading zone and optimal trade entry are not isolated concepts. They are part of a broader framework built around liquidity, market structure, and institutional behavior. While this model focuses on price swings, Fibonacci retracements, and precise entry placement, the same logic applies to many high-probability setups based on liquidity manipulation and false moves. One strong example of this logic is the turtle soup strategy. While optimal trade entry defines where we want to enter within a trend, turtle soup focuses on liquidity sweeps and failed breakouts as reversal triggers. Together, these approaches help you better understand traps, reversals, and smart money behavior, forming a more complete and structured view of how the market really moves. Now let us continue and talk about liquidity sweeps, because this is the event that activates the turtle soup setup. Without a sweep, there is no trade. A liquidity sweep happens when large orders enter the market and intentionally trigger clusters of pending buy or sell orders. This creates fast and aggressive price movements that often catch traders off guard. These sweeps always occur at buy-side or sell-side liquidity levels. They are not random. They happen where stops are concentrated and where the market can access liquidity efficiently. A sell-side liquidity sweep occurs when price moves down into a sell-side liquidity level, trades below it, triggers stops from buyers, and then quickly reverses back upward. A buy-side liquidity sweep occurs when price moves up into a buy-side liquidity level, trades above it, triggers stops from sellers, and then quickly reverses back downward. This sharp rejection after the sweep is the first clue that the breakout was not real and that price may be preparing for a move in the opposite direction. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.